In today's episode of the Daily Brief, I have two interesting stories. In the first one, I'll give you a roundup of what happened in Indian banking in 2025. And in the second story, we'll see when Indians expect prices to fall, what happens to their portfolios. Hello and welcome to the Daily Brief show by Zerodha, where our aim is to cut through the noise and bring you the biggest news in financial markets in a way that's one level deeper as compared to other news channels. I'm your host, Kashish Kapoor. Today is Monday, 12th of January. Banks are one of the biggest moving parts of the Indian economy. And the funny thing is, if you want a quick snapshot of what's going inside of them, you'll never run out of data. So as we step into 2026, it feels only fair to do a proper year-round wrap of banking and financial institutions. And for that, we're leaning on the RBI's freshest set of cues. Its report on trend and progress of banking in India and its financial stability report. Both of these were released over the last few weeks. The plan is simple. No heavy jargon, just a clean story with few charts, a handful of numbers, and bigger narratives we could piece together from what the RBI was telling us. Let's start with the headline that everyone loves. Low NPAs, but with an asterisk. Bad loans are at a multi-decade low. Gross NPAs are down to 2.2% of total advances. That's an insanely clean number for Indian banking. And honestly, if you've been following banking or reading the Daily Brief, you've seen this trend build year after year. Every year, NPAs seem to hit a new low. But it's worth pausing here because there are two ways to get to a low NPA ratio. One is straightforward. You stop making bad loans. The other one is less talked about. You get quicker at clearing old bad loans off your balance sheet. Indian banks have done both, but the second part has played a larger role than the headlines suggest. Here's what that looks like in numbers. In FY 2024-25, banks added about 2.26 lakh crores of fresh NPAs. But the overall stock of NPAs still fell by about 2.75 lakh crores. That gap exists because banks cleaned up the books through multiple channels, and the biggest one by far was write-offs. Banks wrote off 1.58 lakh crores in FY 25. Actual recoveries were roughly 0.68 lakh crores. None of this is wrongdoing. Write-offs are a legitimate tool. Banks accept the loss, take the hit, and move on. But it changes what the 2.2 GNPA headline really means. A low NPA ratio is not only about better repayment behavior. It is also about how aggressively banks are pushing legacy stress out of the system and how fast the loan book is growing in the background, which makes the ratio look even better. The same nuance shows up in insolvency recoveries too. Under the Insolvency and Bankruptcy Code, IBC, many large cases have been resolved, but often after deep haircuts. As of September 2025, creditors had resolved cases with 12.3 lakh crore of admitted claims, but realized only 3.99 lakh crores, roughly 32% recovery, implying a 68% haircut. That is still better than dragging cases endlessly, but it is not the same as banks getting their money back. Another quiet piece of this cleanup story is banks selling stressed loans to asset reconstruction companies. We've done a story on this as well. ARCs buy bad loan portfolios from banks at a discount and then try to earn a return by recovering more than what they paid for. It's a standard mechanism, but what's interesting is what the RBI's data is showing now. Banks are selling more stressed assets and they're getting paid less for them. This again doesn't mean anything shady is happening. It reinforces the broader point. A chunk of the clean balance sheet story is coming from banks choosing to exit loans faster, even if it means taking a hit and accepting a lower price, because the priority is to get the loans off the books. Let's talk about another trend. App-based loan companies, digital NBFCs and peer-to-peer platforms have exploded onto the scene lately. The allure is obvious. Using alternative data and slick user interfaces, fintechs can onboard borrowers quickly, often younger customers who might not have long credit history. The majority of these fintech loans, over 70% of them, are unsecured, essentially digital personal loans or credit lines, and more than half of them are going to borrowers under 35. But the RBI's financial stability report is also quietly waving a flag here. It points out that personal loans originated by fintechs have seen higher impairment losses than broader NBFC universe. More tellingly, it highlights a very specific stress pattern. Borrowers who have taken loans from 5 or more different lenders show significantly higher impairment, that's default rates. That's usually what credit saturation looks like in real life. Not one big loan going bad, but a lots of small loans stacked on top of each other across multiple apps until repayment simply breaks. And this isn't hard to explain, it's structural. Fintech lending is heavily skewed towards unsecured products, often with less depth of information than a bank would typically demand. A bank underwriting a home, let's say, has collateral, income documents, long repayment history, and time. A digital lender might approve a 50,000 rupee loan to a first-time borrower based on a PAN card and some digital signals. Now, that speed is very good for access. It's also fragile if borrower's income takes a hit or if they borrow again and again from other apps. And no, this risk doesn't stay neatly just inside the fintech ecosystem. In many cases, it loops right back into the banking system because a lot of fintech lending is ultimately funded by banks or done through partnerships via credit lines, co-lending arrangements, or banks buying out loan pools. So if defaults rise in fintech originated books, the pain doesn't remain a fintech problem for long. It eventually shows up on mainstream balance sheets. Another piece of the puzzle is the intricate dance between banks and NBFCs. NBFCs often originate loans that banks then buy, co-lend on, or fund indirectly. In theory, it's a win-win. NBFCs can reach customers and geographies that large banks don't. And banks can scale up lending quickly without building the entire distribution network themselves. Banks also get an easier route to retail growth and priority sector exposure, while NBFCs get access to cheaper funding and a larger balance sheet partner. All that's good. But the RBI's financial stability report offers a useful reality check. Moving risk around doesn't really remove it. It can actually make it harder to see at times, and in some cases, even more concentrated. The data here is eye-opening. You see, banks have been increasingly leaning on NBFC-originated assets to pad their loan books, and about 80% of these acquired loans come from just a handful of big NBFC players. If even one of those NBFC partners hits trouble, the shockwaves would reverberate through multiple banks that had been feeding off its pipeline. The RBI bluntly calls this out as concentration risks. Banks might think they're diversifying by buying loans instead of lending directly. But if they're all buying from the same NBFCs, they're effectively placing the same bet. There's also the question of asset quality in these partnered loans. Interestingly, the FSR notes a divergence here. Private banks have generally bought higher quality pools, which means their acquired loans perform better, even better than the NBFC's own books in some cases. Whereas public sector banks have chased yield and volume to their detriment. For public sector banks, the loans they acquired via direct assignments or co-lending have seen higher loan losses than the ones they themselves originated. As of September 2025, public banks' co-lending NPAs were around 5.7%, compared to just 2% for private banks' co-lending books. All these threads tie back to a common theme that risk hasn't disappeared, it's just shifting locations. Banks and NBFCs are now tightly interlinked. Banks lend to NBFCs and buy NBFC loans. NBFCs depend on bank funding and promise banks easy growth. It's a symbiotic loop which works great until it doesn't. Now, so far we've stayed on the asset side, which means loans, credit growth, and how clean or not so clean those books really are. But banks don't just run on loans, they run also on funding. That's where 2025 throws up another quite a contradiction. Credit has been booming, but deposits have been harder to gather. Through the second half of 2025, banks slipped back onto a familiar race, competing aggressively for household savings. Loan growth kept running ahead of deposit growth, and that creates a simple problem, a funding gap. Banks can manage it for a while through market borrowings, CDs, or short term money. But structurally, if deposits don't keep up, the system starts to feel a bit tighter. What's interesting is that this pressure had eased after 2022 peak when lending was exploding and credit deposit ratios were a bit stretched. For a bit, things cooled off and funding stress looked manageable again. But by late 2025, the heat had started returning. Now, why should we care about this? Two reasons: profitability and stability. First, customers are keeping less money idle in low interest bank accounts. Now, to compete, banks had to jack up deposit interest rates, which squeezes their net interest margins. The RBI noted that banks' profit growth had moderated in 2024-25, partly due to narrower interest margins. Second is stability. If deposit growth persistently lags credit growth, banks might be tempted to take on more volatile funding to fill the gap, like short-term market borrowings or certificates of deposits. That can make them more vulnerable to interest rate swings or liquidity crunches as well. Now, the RBI is cognizant of this, deposit puzzle. They haven't sounded the alarm bells. After all, overall deposits are still growing healthy in absolute terms, but the subtext is very clear here. Banks must not neglect their liability franchise in the chase for asset growth. So, what should we watch in 2026? Now, if NPAs are this low today, what keeps them low tomorrow? Do we genuinely enter a phase where fresh bad loans slow down too, even if parts of the cycle like microfinance are starting to look shakier? Or do we keep seeing clean balance sheets, mainly because banks are getting faster at pushing stress out through write-offs and asset sales rather than actually pulling money back through recoveries? And then this fintech boom, it's already been through multiple regulatory crackdowns. But does tighter scrutiny actually change behavior in a meaningful way? Does it slow down the speed and scale of unsecured digital lending, or does the industry simply adapt and just keep moving, just with different wrappers and better paperwork? The bank NBFC partnership model is another one. It's not inherently bad. It's helped credit reach places banks alone won't. But can it become truly diversified? Or will we keep seeing the same pattern? Too many banks depending on the same few originators and the same kind of loan pools, the same risk showing up everywhere at once. And then finally, there's deposits, the most old school constraint of all in banking. If loans keep growing faster than deposits, what's the release valve? Do banks get more creative in attracting savers, build new deposit propositions, and compete harder for household money? Or is the answer simpler and more painful? Pay higher deposit rates, accept that funding costs rise, and live with lower NIMs incrementally. These aren't worries, they are moving parts, and 2026 will tell us which version of this story is real. We recently covered how deposit insurance shapes India's risk appetite, how a policy tool designed to prevent bank runs ended up influencing whether people hold stocks or bank deposits. Today's story covers similar territory, but the stimulus is different, that of inflation expectations. What happens when people start expecting inflation to fall? A new research paper explores exactly this. Their findings reveal a nuanced relationship between how Indians expect prices to work, how we invest, and why we love liquidity so much. Let's dive in. In February 2015, in order to aggressively reduce inflation, the RBI formally adopted inflation targeting. What this means is that for the first time ever, the central bank committed to reaching the specific inflation rate of 4%, give or take 2 percentage points. Earlier, India followed a multiple indicators approach, which tracked many variables without committing to a numerical target. Now, in the absence of a target, the paper says people never really had uniform expectations of how prices of the goods they buy might change. This varied widely across cities, age groups, and income levels. Someone in Mumbai, for instance, might expect 8% inflation, while someone in Bhubaneswar expected 12%. However, the 2015 policy changed that. With the presence of a real target that the government is aiming for, households got a concrete anchor. The range of expectations had basically narrowed down now. People who expected inflation to be higher would revise their expectations downward, while those who expected lower inflation would mark their assumptions upward. Such an anchor would make the outcomes of a policy change much more predictable and therefore more measurable for the authors. This expectation of inflation, however, is not the same as what actual inflation rate might be. You might expect prices to fall by 5% in a year, but they might actually decline by 1%. This paper deals entirely with those expectations instead of actual rates. The RBI does also guide their inflation policy based on these expectations, but that's a separate topic. But what do people actually do with their money when their expectations of inflation change? That's where the authors introduce a little economic theory. Say that inflation expectations fall. If the interest rates on bank deposits stay constant, the real return on savings remains high. After all, there is no high inflation to erode the returns you've earned. A fixed deposit paying 7%, for instance, looks more attractive if you expect 4% inflation than if you expect 8%. So to earn those better returns, households should consume less today and save more. This is the consumption-Euler equation at work. But there's another force. Lower inflation expectations often come with lower uncertainty about the future. After all, households feel that there are less risks to how high their purchasing power could be over time. If they feel more certain about the future, they don't need to hoard as much for emergencies at present. The precautionary savings motive weakens and people might actually spend more and save less. So, which effect wins? It depends on how much liquid savings you have, and that's what the paper sets out to measure. The researchers found that when RBI announced an inflation targeting scheme, households changed their consumption and investment based on how much liquidity they already had. Households with higher liquidity saw consumption-Euler equation effect dominate. As they expected inflation to fall, bank deposits looked more attractive. For households in highest savings quintile, those with average of 6.24 lakh in their account, a 1 percentage point fall in inflation expectation led to an 82 rupee drop in their monthly consumption. These households also increased their bank deposits by 1,266 rupees per month. However, for households with lower liquidity, averaging just 23,000 rupees in savings, the precautionary saving effect was actually stronger. The same 1 percentage point drop in inflation expectation led to 54 rupee increase in monthly spending and 443 rupee decrease in bank deposits. Lower uncertainty meant these households felt comfortable spending a bit more rather than hoarding cash. Naturally, this also means that one's income level can strongly shape how they expect inflation to play out. In aggregate, these two effects often partly cancel each other out. Wealthier households consume less, while poorer households consume more. At the macro level, it looks like nothing happened, but underneath, behavior is moving in opposite directions. Now, what do these new inflation expectations of higher saving households mean for their portfolio? That's where the paper finds very interesting patterns. While these households now find investment much more attractive, they may not increase their risk appetites. Instead, with lower inflation expectation, they actively reduce their equity and mutual fund holdings and reallocated funds towards bank deposits. This wasn't fear-driven selling after a market crash or a crisis. There was no spike in volatility, no panic. It was purely strategic allocation. The logic comes down to how different assets respond to inflation expectations. Bank deposit rates in India are notoriously sticky. They don't change too often. During the study period, the savings account rate sat fixed at 4% across all major banks. It didn't move even when the RBI cut rates. As a result, the real return on these deposits rises when the banks hardly change their actual rates, purely because people don't expect inflation to rise. Stock returns, on the other hand, do adjust. Equity markets usually price in inflation expectations. When expected inflation falls, nominal returns tend to fall as well, leaving real returns roughly unchanged. This makes the bank deposit more attractive in favor of equity investments. What also increases its attractiveness is its risk profile. The bank deposits is the ultimate safe asset. People believe that no matter whether rain or shine, they will earn the return promised by the bank. Its risk-return mix then ends up looking much better than that of equity and mutual fund holdings, which households perceive as being far more volatile. In the deposit insurance story, we saw that Indian households had an unsatisfied demand for safe assets. When they were sure that the government would insure a bigger chunk of their bank deposits, they actively sold their equity holdings and reallocated towards bank deposits. The equities they did sell were PSU stocks, which in a way are also safe assets that people strongly believe are protected from failure by the government. In a way, lower inflation expectations reflect that same hunger for safe assets. Now, one might ask, why not bonds? This is because at the time, India lacked the infrastructure needed to enable large scale retail participation in the bond market. When it comes to liquid safe assets, bank deposits are automatically perceived as the default. Another telling finding involves debt. Among households in the top savings quintile who had existing loans, a percentage point fall in inflation expectations led to 760 rupees increase in monthly loan repayments. Why is that? See, most household debt in India carries a fixed nominal interest rate. It's not indexed to inflation. If, for instance, you have a home loan at 8.5% and you expected 8% inflation, your real borrowing cost was effectively 0.5%. If inflation expectations drop to 4%, the real cost suddenly looks like 4.5%. The debt hasn't changed, but it feels a lot heavier. Naturally, households responded by paying down loans faster. After all, as our borrowings isn't linked to inflation, scheduled repayments would stay the same or even fall if the RBI cuts rates. This also supports the effect of consumption euro equation. In our deposit insurance story, we'd mentioned that it's hard to tie down India's risk appetite to any one factor. Much like deposit insurance, inflation and its expectations is a reflection of that appetite, while also influencing it in interesting ways. Policymakers attempting to influence either consumption or investment at a nationwide scale will have to pay heed to these findings. Wealthier ones respond to falling inflation expectations by saving more and shifting to safe assets, while poorer ones respond by spending a bit more as uncertainty fades. However, lower inflation doesn't necessarily make households less risk averse. If anything, lower inflation makes the bank deposits, the most trusted safe asset in India, more attractive compared to the stock market. And now, on to the tidbits for the day. India plans to scrap 5-year-old restrictions on Chinese companies bidding for government contracts imposed after the 2020 border clash. Ministries say that curbs caused project delays and equipment shortages, especially in power projects. The final call will rest with the PMO, even as limits on Chinese FDIs stay in place. Next up, Vodafone Idea will pay up 124 crore annually from FY26 to FY31 after the government froze its total AGR dues at 87,695 crores. It will then pay 100 crores a year till FY35, with the balance sheet reassessed later. The relief improves Vodafone Idea's survival chances and ability to raise bank funding. And finally, Reliance Industries said it would consider buying Venezuela crude if sales to non-US buyers are permitted. The oil could offer cheaper heavy crude and help diversify away from Russian supplies. Reliance stopped Venezuelan imports in 2025 after US tariffs, but says discontinued barrels could improve refinery economics. And that's it for today. We'll see you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.